Welcome to the Manual of Accounting Procedure, General. In this video, we'll walk through the essential guidelines and practices that form the foundation of effective accounting procedures. Let's begin. In this section, we'll discuss the administration of the Employees Provident Funds and Miscellaneous Provisions Act of 1952, along with the schemes associated with it. This act serves as a key legislation governing provident funds and retirement benefits for employees in India. The three schemes under the Employees Provident Funds Act are administered by the Central Board of Trustees. This tripartite body includes a chairman, a vice-chairman, 5 central government representatives, 15 state government representatives, and 10 members each representing employers and employees. The board is supported by an executive committee, established by the central government in 1990, and 4 subcommittees: the Finance and Investment Committee, the Committee on Exempted Establishments, the Committee on the Special Reserve Fund, and the Pension Implementation Committee. To ensure smooth functioning and recommend improvements at the regional level, the Central Board is assisted by regional committees. These committees are formed on a tripartite basis by the chairman of the Central Board, including representatives from employers, employees, and government officials at the state level. The Finance and Investment Committee plays a crucial role in overseeing investments, ensuring the timely collection and reinvestment of trust funds, with the goal of maximizing returns. It provides necessary directions for investments within the framework approved by the central government and reviews the rate of interest for fund members. The accounts wing of the organization is led by the financial advisor and chief accounts officer at the central office. Let us discuss the general office procedure. Under the Act, all establishments and factories must be allotted a code number by the enforcement section at the regional office. The details of these establishments, including their code number, name, address, industry, and district, are maintained in the establishment master within the MIS. A separate register is kept for establishments exempt from the EPF scheme, 1952, the EP scheme, 1995, and the EDLI scheme, 1976. The enforcement section must also collect Form 5A from all covered establishments. Code numbers are allotted to the Accounts section in consultation with the Regional Commissioner of Finance and Accounts. To streamline operations, work is distributed district-wise, which improves efficiency in processing claims, generating defaulter lists, and distributing correspondence. Additionally, clerks and section supervisors should rotate tasks every 3 years to ensure transparency and prevent stagnation in any section. All incoming mail is sorted group-wise by the Central Registry section. Each group's receipts are further categorized into letters, claims, and returns, and a running serial number is affixed to each. Registered and registered acknowledgement due posts are stamped upon receipt. Each clerk maintains a work diary in a prescribed format, recording details such as letters, transfers, advances, claims, bills, forms, challenges, miscellaneous reports, and returns received. The diary also includes a summary of daily tasks, submitted to the section supervisor. Additionally, a weekly progress report is prepared by each clerk on the disposal of letters, claims, bills, and transfers. A reminder register is maintained, with entries made based on reminder due dates noted during the approval process. When preparing drafts, the section letter and file number must be entered at the top, with the subject matter and reference details clearly noted at the beginning. Drafts should be written in clear, concise, and courteous language. If enclosures are included, they must be clearly mentioned in the draft, with the number of enclosures indicated at the bottom left. No alterations to an officer-approved draft should be made without their consent and initials. Each letter should address only one subject, unless topics are closely related. When addressing an officer by name, ensure the correct spelling and mode of address. All relevant references must be flagged or page numbered in the draft for easy navigation. All notes must be concise and to the point. Lengthy notes should conclude with a brief summary of the key points for consideration or decision, with paragraphs numbered sequentially. Avoid verbatim reproductions or paraphrasing of existing papers or correspondence in the same file. Officers should focus on the actual point when passing orders or suggestions, simply appending their signature if they agree with the previous note. When referring to facts, officers should direct attention to the relevant section of the running summary of facts, rather than repeating information. If a summary is not available, a self-contained summary should accompany each case, outlining key facts and opinions. Criticisms or corrections should be made in courteous, temperate language, avoiding personal remarks. For cases with multiple major points, each should be addressed separately in sectional notes. Lastly, the dealing clerk or section supervisor should initial the note with the date on the left, while officers will sign on the right-hand side. Each section will maintain approved lists of standard heads, representing the main subject categories. These heads are assigned consecutive serial numbers, but no numbers are allotted to subheads. Before opening a new file, the relevant standard head is identified, and a title is proposed for approval. The title includes the standard head, a subhead indicating the specific subject, and a brief description of the issue at hand. Every file is assigned a unique number, consisting of 4 elements: the serial number of the standard head, the file's serial number for the year, the last 2 digits of the year, and a section identifier. The first 3 elements are separated by slashes, and the last by a dash. Papers to be filed will be punched in the top left corner and tagged to the appropriate section of the file, such as notes or correspondence, with the most recent papers on top. Typically, each section is kept in a separate file cover. However, if both notes and correspondence are not bulky, they may be filed together, with correspondence on the right side and notes on the left. Routine documents like reminders and acknowledgements will be kept separately and discarded once no longer needed. If a file section exceeds 100 pages, it will be stitched and labeled as Volume I. Any additional papers will go into subsequent volumes, marked Volume 2, and so on. Each page in the file is consecutively numbered in pencil, with blank pages left unnumbered. Every correspondence, whether a receipt or issue, is assigned a serial number, marked in red ink at the top right corner of the first page. The paper under consideration is flagged as PUC, while the latest fresh receipt is labeled FR. If multiple fresh receipts exist, they are flagged as F.RI, F.R.2, and so on. When referring to flagged papers, the relevant page numbers must be noted in the margin. Other papers in the file are referenced by page numbers alone. For quick identification, recorded files and accompanying papers are flagged with alphabetical slips, with only one slip attached per file or compilation. To help identify references to papers from other files after removing slips, the file number being referred to must always be quoted in the body of the note, with relevant page numbers and alphabetical slips indicated in the margin. Similarly, when referencing orders, notifications, resolutions, or legislative documents like acts and rules, the file number, date, and relevant section, rule, or clause should be mentioned in the body of the notes. The alphabetical slips will be indicated in the margin. If rules or compilations are already available to the officer reviewing the case, there is no need to include them in the submission. When a clerk is transferred, they must hand over all documents and registers in their custody, including pending letters, nomination forms, claims, and settled cases, to the incoming clerk. This process requires a proper handover report, signed by both clerks, and submitted to the section supervisor and officer in charge. If only a specific task is being transferred, a separate report must be prepared for the related documents. A copy of this report is sent to the administration section. In the case of transferring records between regional and sub-regional offices, extra care is taken by preparing an inventory for each document type under the guidance of a senior officer. To ensure files are neither destroyed prematurely nor kept longer than necessary, the retention periods for records are outlined in the annexure. Certain records must be preserved for as long as required by their nature. These include records related to expenditure with legal limitations, expenditure records for incomplete projects or works, records concerning ongoing claims related to service or personal matters, permanent orders and sanctions, until revised, records for unaudited periods, any records needed for resolving audit objections. The Accounts section plays a key role in monitoring and scrutinizing various returns and ensuring timely follow-up actions. It maintains accounts for the Employees Provident Fund, Pension Fund, and Insurance Fund, as well as registers like the Demand Collection and Balance Register. It is responsible for safeguarding original documents such as Form 9, Form 2, Form 3, and Form 1, and conducting audit scrutiny of all account returns. Additionally, the section scrutinizes advance and withdrawal applications, authorizes payments, and handles the settlement of accounts under all three schemes. The section also manages benefit payments under the Employees Pension Scheme, 1995, and the Employees Deposit Linked Insurance Scheme, 1976. The cash branch, on the receipt side, ensures timely receipt of challans and bank statements, and monitors missing credits or challans. It prepares subsidiary cash books through the EDP system and promptly provides the schedule of receipts to the Accounts section. The branch also reconciles receipts across various accounts, maintains cash books, and handles the adjustment of erroneous receipts or account transfers. Proper maintenance of challans and bank statements is a key responsibility. Additionally, the branch ensures the realization of interest on all bank accounts and recovers interest from the State Bank of India for delayed fund transfers. Let us discuss the duties and functions of cash branch on the payment side. Functions of the cash branch, focusing on the payment side. First, the maintenance of essential documents such as cash books, check books, blank money orders, and other valuable documents is critical. The branch is also responsible for maintaining the bills register and ensuring timely payments. Additionally, the branch prepares and submits all financial returns, ensuring accuracy after verifying details from the receipt side. To keep track of incoming payments, the scroll inward register is maintained. The branch ensures periodical transfers to other accounts or investments when due. Next, it manages the transfer of surplus funds in administration accounts number 2 and 22, moving these to investment accounts number 4 and 24, which are maintained at the State Bank of India, New Delhi. The branch receives scrolls of authorized claims and processes payments via money orders or checks, ensuring prompt forwarding of paid scrolls to the Accounts section. Monthly reconciliation statements for all cash books are prepared, along with a classified summary of receipts and payments across all accounts. A balance sheet of receipt and payment accounts is also compiled each month. Finally, undelivered money orders or checks are managed by forwarding intimation to the Accounts branch and ensuring proper recredit notifications. The dispatch of check money orders, registered letters, and other documents from the cash section is also handled efficiently. In this section, we'll discuss the key responsibilities of the financial advisor and chief accounts officer who oversees the accounting side of the organization. Their first task is to regularly scrutinize existing accounting procedures to ensure they meet the needs of the organization. This includes assessing whether changes or improvements are required, and suggesting new, more efficient accounting methods when necessary. They also oversee the investment of the organization's funds, ensuring that investments are both proper and judicious. Another important function is the assessment and declaration of the rate of interest applicable for each financial year, ensuring the organization's financial health. The financial advisor and chief accounts officer is responsible for compiling and presenting the budget estimates and managing reappropriation of funds when needed. They also lead the preparation of the organization's annual report, particularly focusing on the final accounts. Furthermore, they handle the consolidation of the annual pro forma accounts and are responsible for responding to audit report queries, ensuring full compliance and satisfaction of the audit authorities. Lastly, they work on simplifying procedures and systems within the organization, conducting work studies, setting work norms, revising forms, and managing the payment of productivity-linked bonuses through the internal work study unit. Let's look at the key responsibilities of the regional head, who plays a crucial role in enforcing the provisions of the Act and scheme across the region. Firstly, the regional head ensures that discipline, punctuality, and decorum are consistently maintained within the office environment. Additionally, they must strictly adhere to guidelines from the central office, especially regarding job content and distribution of work among RPFCs and APFCs. One of their key tasks is to coordinate the work between sub-regional and regional offices, conducting monthly operations and management meetings to discuss new amendments and procedures for uniform implementation across all offices. The regional head is also responsible for conducting inspections of sub-regional offices and the inspectorate, as well as releasing an inspection calendar for internal audits by Assistant Provident Fund Commissioners. Ensuring financial propriety and discipline within the region is critical, as is ensuring the timely disposal of court cases. Monthly review meetings are held to assess all the branches, including administration, cash, legal, recovery, enforcement, accounts, audit, EDP, and pension, ensuring that all units are performing efficiently. The regional head also oversees the proper conduct of departmental examinations, personally addresses staff grievances, maintains sound industrial relations, and expedites departmental inquiries and reviews of suspension cases. Finally, they ensure that all vacancies are promptly filled under their authority and submit proposals for other cadre, while enforcing punctuality, discipline, and a positive office atmosphere. Next, we will outline the core responsibilities of the Finance and Accounts Officer for the entire region. Firstly, they are in charge of finance and accounts across the region, providing essential support to the Regional Provident Fund Commissioner in all accounting matters. They ensure uniform accounting procedures, particularly in areas such as account settlements, grant of advances, transfers, crediting of interest, and issuing annual account statements, ensuring strict compliance with scheme provisions. The Finance and Accounts Officer assists the Regional Commissioner in ensuring that final accounts, advances, transfers, and annual statements are efficiently managed and completed within the stipulated time. They are also responsible for the compilation of budget proposals and handling reappropriations promptly and accurately. Managing the region's banking arrangements and supervising the cash section is a key part of their role, including ensuring timely cash transfers for investments. The officer oversees pre-audit work, carefully examining all proposals with financial implications and advising on ways to control administrative expenses. In addition, they maintain all cash books and prepare corresponding schedules of receipts. This includes ensuring the prompt submission of monthly returns, providing a classified summary of receipts and payments, including final accounts and the balance sheet, to the central office. Let's take a closer look at the duties of the Assistant Commissioner, Enforcement, whose primary role is enforcing the Act and scheme. First, they ensure the enforcement of the Act and scheme, ensuring compliance across all establishments. A key responsibility is the assessment of dues through inquiries conducted under Section 7, which involves determining the liabilities of employers. They also monitor faults and non-compliance within the system and work towards the recovery of arrears from defaulters. In cases where the Assistant Commissioner, Legal, is unavailable, they handle legal matters related to enforcement, ensuring continuity in legal proceedings. The Assistant Commissioner is also responsible for imposing penal damages on defaulters, ensuring strict enforcement of penalties as per the regulations. In addition, they manage any other work related to enforcement, damages, and legal matters, ensuring that the organization stays compliant with all legal and financial obligations. Recovery of arrears remains a top priority, and they handle any other duties associated with the recovery process. In this section, we'll discuss the receipt side responsibilities of the cash branch, focusing on monitoring with the banks and managing financial transactions effectively. Firstly, the branch ensures the prompt receipt of challans and statements from the State Bank of India on due dates. If there are delays in credits, missing challans, or incorrect interest rates, they promptly correspond with the bank to resolve these issues. The branch is also responsible for the maintenance of cash books. This involves conducting daily reconciliation of receipts across various accounts, such as accounts numbers 1, 2, 10, 21, and 22, and attesting the schedule of receipts for all sections. The schedule of receipts must be submitted to the accounts section by the 10th of each month, and this schedule must be certified by the Assistant Provident Fund Commissioner. In case of erroneous credits or non-receipt of challans, the branch takes immediate corrective action to rectify these discrepancies. Lastly, the branch ensures the periodical transfer of funds, including the movement of surplus funds from administration accounts to investment accounts, ensuring funds are invested promptly and effectively. We'll cover the key responsibilities related to the payments side, focusing on the maintenance of cash books and important financial documents. First, the officer ensures the proper maintenance of the cash book, impressed cash book, and undisbursed pay register, all managed by the cashier. It is essential that daily transactions are accurately recorded and properly attested. Next, the officer oversees the valuable documents register, ensuring prompt receipt and disposal of checks and demand drafts received from employers. Entries must be properly attested to ensure transparency and accountability. Lastly, they ensure reconciliation of cash books for all accounts, including accounts numbers 1, 2, 10, 21, and 22, ensuring accuracy and proper attestation of daily transactions. In this section, we'll cover the responsibilities related to the timely submission of coverage proposals under the Employees Provident Funds Act, 1952. The first responsibility is ensuring that every establishment meeting the requisite employment strength is brought under the Act's coverage through timely submission of coverage proposals. Next, if an establishment is not statutorily coverable but both the employer and the majority of employees request coverage under Section 1(4) of the Act, a recommendation for coverage is made. Once an establishment is covered, it is critical to secure full compliance by the employer to ensure they adhere to all legal requirements under the Act. The officer is also responsible for addressing the problems of employers and resolving any employee grievances. If issues cannot be resolved at their level, the matter is reported to the Regional Provident Fund Commissioner for further action. They are also tasked with conducting surveys to assess the coverage potential of new establishment categories when instructed. Additionally, they supply prescribed forms to employers upon request, educating them on proper completion and prompt submission to the regional or sub-regional offices. Any evasion, abuse, or violation of the Act, as well as defects in its implementation, must be reported to the Regional Commissioner for corrective action. Finally, The officer is involved in prosecuting defaulters under Section 14 of the Act and relevant sections of the Indian Penal Code, ensuring legal action is taken when necessary. We'll outline the key duties of the enforcement officer in supporting the organization's enforcement and recovery functions. One of the primary responsibilities is to assist the recovery officer in realizing arrears, ensuring timely and efficient recovery from defaulters. The officer is also tasked with monitoring establishments exempted under Section 17(1), 17(1)(c), and 17(2)(a) of the Act. They must ensure that these establishments comply with the Act's provisions and the conditions of exemption set by the appropriate government authorities. Timely submission of inspection reports, narrative reports, survey reports, and other required reports is crucial, ensuring they are submitted within the stipulated deadlines. The officer also serves summons and warrants in prosecution cases, helping to expedite legal processes in the organization's best interest. Additionally, they must follow the instructions outlined in the Manual for Enforcement Officers, ensuring all procedural requirements are met. Lastly, the enforcement officer carries out any additional tasks assigned by the Assistant Provident Fund Commissioner or Regional Provident Fund Commissioner, assisting in various enforcement operations as needed. In this section, we'll explore the key responsibilities of a section supervisor, focusing on the effective management of receipts and staff supervision. The first duty of the section supervisor is to examine all incoming receipts relevant to their section and ensure proper distribution among the staff. If any receipt is marked as immediate, difficult, or of special nature, the section supervisor must either handle it personally or provide specific instructions to ensure quick and efficient disposal. To maintain efficiency, the section supervisor ensures that all immediate receipts are handled on the same day they arrive, urgent receipts within the next day, and ordinary receipts within 3 days. No receipt should remain pending for more than 7 days. They are also responsible for scrutinizing the notes and drafts prepared by assistants and clerks, revising them if necessary, and submitting them to their superior for approval, when required. Once drafts are approved, the section supervisor ensures they are issued promptly, and office copies are properly added to the relevant files without delay. Lastly, they monitor the submission and receipt of periodical returns, ensuring everything is handled well within the prescribed deadlines. As part of effective office management, it's crucial to ensure that important cases are noted in personal calendars or notebooks for prompt action by the specified date. A sectional notebook is maintained for recording key decisions, with entries made immediately for future reference. Files with completed actions are promptly indexed, stitched, and recorded for proper documentation. Weekly scrutiny of work diaries, registers, and other records is conducted to ensure they are properly maintained, with initials added after each review. All papers, files, and documents are arranged properly, and unnecessary items are regularly weeded out to maintain order. As part of ensuring smooth operations, it is essential to monitor attendance, maintain order and discipline, and provide training and guidance to staff. Regularly review the work of assistants through their work diaries. Ensure all tasks are handled methodically, with efficiency in men, materials, and time, while suggesting improvements in work methods. Ensure important scheme forms are received and audited on time according to the schedule. Track claims through a computerized inward register, daily monitoring the status of claims, whether settled, rejected, or pending. Distribute work equitably among staff to handle all applications for advances, transfers, and final settlements. Ensure that all claims are disposed of within 30 days, and adjust staffing if claim volume is high to meet this deadline. Maintain the annual accounts progress register, ensure timely receipt of Form 3A and issue annual accounts within the stipulated time. Furnish weekly reports on all work areas, maintain monthly progress registers, and verify the entries in personal registers. Arrange for the timely levy of damages where applicable. To watch the receipt of utilization certificate documents respect of 68B withdrawals and initiate action of recovery in respect of all misusals. To ensure the maintenance of returns rejections of claims with the prescribed columns and furnish the statement of rejected returned claims to EDP cell for data entry. To ensure the proper compilation of weekly monthly reports and MIS reports and submission within the due date. To perform any other function that may be assigned to him from time to time by his immediate superior or other superior officers. To ensure compilation of annual accounts of all the establishments and issue of the individual statement of account of the members by the 30th September each year. To ensure the checklists received from the EDP cell are sent back to EDP cell for generation of output reports and the Form 23 as and when generated are dispatched without any delay. To ensure proper scrutiny, processing and finalization of all claims strictly in accordance with the date of receipt including transfer applications, within the prescribed time limit and in the process giving priority to the claims received from the beneficiary of the deceased members. Under Para 52 of the Employees Provident Funds Scheme, 1952, funds belonging to the EPF must be deposited in approved banks such as the Reserve Bank of India, RBI, State Bank of India, SBI, or other scheduled banks as approved by the central government. With the government's approval, State Bank of India has been appointed as the banker for the Employees Provident Fund, Pension Fund, and Insurance Fund. Regarding the nature of accounts, the head office, regional offices, and sub-regional offices are authorized to open and operate savings bank accounts only in SBI. The applicable savings interest rate is realized from SBI's link branches and from their Mumbai and New Delhi offices, in accordance with the rates applicable from time to time. It is crucial that the State Bank of India, SBI, branches remit the daily contributions and other dues received to the concerned link branch on the same day. Any delay in this transfer can lead to late investments by the Employees Provident Fund Organisation, causing a loss of interest to the fund. To address this issue, a scheme for payment of interest on belated credits has been implemented in consultation with SBI. The link branch monitors timely transfers from base branches. If delays occur, the base branch is held accountable, and interest on belated credits is paid to the EPFO. Interest is applicable when delays exceed the prescribed period. For delays beyond 7 days, interest is payable. In the case of empties drafts from branches in the Northeast region, NER, and Sikkim, interest is charged for delays exceeding 10 days. This ensures the funds are credited promptly, protecting the financial interests of the EPFO. The remittance charges of ₹2.50 per 1,000 rupees on total contributions received by SBI base branches on behalf of the EPFO and transferred to the link branch are payable to the link branch by the respective regional office every month. The link branches recover these charges on the total contributions credited to the following EPF accounts at the end of each month. Account numbers 1, 2, 10, 21, and 22, excluding transfers from other accounts. Regional offices must ensure they receive detailed remittance statements showing the period, account-wise credit totals, and the charges debited to account number 2. It's critical to verify the accuracy of these charges and ensure any erroneous charges are adjusted promptly. All monies related to Employees Provident Fund, EPF, contributions, including the employee's share and the remaining employer's share after pension fund diversion, are credited to this account. This includes various sources such as transfer of provident account, PA, dues, interest on securities, penal damages, refund of withdrawals, and proceeds from matured insurance policies. Transfers from account number 5, EPF investment account, at SBI Bombay, under the advice of the FA and CAO CPFC, are also credited here. Any transfers between accounts held at the link branch must be made only on specific advice from an authorized officer in the regional office for rectifications. Payments from this account are made through checks issued by the authorized officer, covering dues under the EPF scheme of 1952. Transfers to other accounts, except for pension contributions to account number 10, EPA's cont, are only allowed for rectifications of erroneous deposits. Any surplus in this account must be remitted by telegraphic transfer to EPF investment account number 5 at SBI's main branch in Bombay on the same day of advice from the authorized officer. This account is used to manage the administrative expenses of the regional offices. Credits to this account include administration and inspection charges received from establishments. Other miscellaneous receipts. Debits from this account cover salaries and administrative expenses of the regional office. Automatic monthly transfers to account number 4, EPF Central Administration account, amounting to 1/6 of total monthly collections, excluding transfers from account number 4. Transfers to account number 4A and account number 8 based on authorization from designated officers. Transfer of surplus amounts to account number 4 upon authorization. Provisional coverage of expenses related to the administration of the Employees Pension Scheme 1995 and Employees Deposit Linked Insurance Scheme 1976. This account serves as the central account for administrative expenses at the EPFO headquarters. Credits to this account come from transfers of funds from the regional administration accounts, account number 2, of all regional and sub-regional offices. Interest earned from investments. Maturity proceeds realized from investments. Debits from this account include pension contributions transferred monthly to the pension congratulatory account, account number 9, calculated based on the total pay of officers and staff reported in the previous year's balance sheet. Transfers to account number 4A, Central Office Local Administration account, account number 9 and account number 2 based on authorization. Investments of surplus funds to optimize financial management. Account number 5 is fed by transfers from account number 1 which holds the Employees Provident Fund contributions. The transfer is initiated based on the instructions of the authorized officer and pooled centrally at the State Bank of India, Bombay. When regional or sub-regional offices require additional funds for payments, and account number 1 falls short, a requisition is submitted to transfer funds back from account number 5 to account number 1. This process is authorized by the Central Provident Fund Commissioner and other key officials. The balance in account number 5 is transferred daily to the Central Board of Trustees investment account for further investments. Lastly, account number 6, also known as the interest suspense account, is a pro forma account with no actual bank account attached. Account number 8 is funded by transfers from account number to the EPF Regional Administration account, as well as from the Central Office's Local Administration account, known as account number 4-A maintained at the SBI main branch in New Delhi. The deposits in this account represent staff provident fund contributions and refunds of withdrawals from employees within the organization. On the 8th, 23rd, and the last working day of each month, the balance in this account is transferred at par to the Central Board of Trustees Staff Provident Fund Investment Account at the State Bank of India, Bombay, for further investment on behalf of the Employees Provident Fund Organisation. Transfers from this account are made based on authorized transfer advice notes. However, final payments, advances, and withdrawals related to staff provident funds are met from the respective regional administration accounts. These transactions are reflected after deducting amounts paid for final settlements and withdrawals. This account is centrally maintained by the central office and is funded by transfers from account number for the EPF Central Administration account at the New Delhi main branch. After maintaining a balance of up to 100 rupees, the remaining funds are transferred on the same day to the Central Board of Trustees EPF investment account for the Pension Gratuity Fund. This account is held at the Security Services branch of the State Bank of India in Bombay, where the funds are invested on behalf of the Employees Provident Fund Organisation. Any other transfers from this account are processed based on transfer advice notes issued by authorized officers from the central office. Payments from this account are issued by the authorized officer through checks for specific purposes. First, withdrawal benefits under the Employees Pension Scheme of 1995 are provided to members. Second, monthly pensions, including returns of capital, commuted value, and pension increases, are paid to pensioners through designated banks. Checks are drawn in favor of Employees Pension Scheme 1995 and sent to the designated bank. Payments are also made to the Postal Department for family pensions under the seized Employees Family Pension Scheme of 1971. Third, service charges to the designated bank and commissions to the Postal Department are paid from this account. Except for rectifying incorrect remittances, no other payments should be authorized from this account. Surplus funds are transferred daily to the Employees Pension Fund Investment Account No. 2, maintained at the Bombay main branch, via telegraphic transfer based on the authorized officer's advice. Following the implementation of the Employees Pension Scheme in 1995, there was a procedural change in how pension funds were managed. The Pension Fund Investment Account was transferred from the State Bank of India in New Delhi to its Mumbai branch on 16 November 1995. The surplus pension fund contributions are now transferred via telegraphic transfer to specific link branches, with the central government's share of contributions remaining in the public account of India. Upon authorization, these contributions are credited to the Employees Pension Fund account number 10 and excess funds are transferred to the Securities Services branch in Mumbai for investment. This account is funded by transfers received via demand drafts or money transfers from various base branches. These transfers represent the employees' deposit-linked insurance contributions made by employers through challenge for account number 21. On the advice of the authorized officer from the central office, any transfers from account number 25, the employees' deposit-linked insurance investment account, are credited to this account. Payments from this account are made through checks, issued by the authorized officer, to provide insurance fund dues to the beneficiaries of deceased Provident Fund members. Any surplus funds are transferred to investment account number 25 at the Bombay main branch on the same day, upon receiving advice from the authorized officer. No other transfers should be made from this account, except for rectifying erroneous remittances. Similar to the Employees Provident Fund Regional Administration account number, to this account is credited with employees' deposit-linked insurance administrative and inspection charges. These are remitted by employers through challenge in account number 22 and received via demand drafts or money transfers from base branches. Payments from this account are made by transferring the total monthly collections to account number 24, the Employees Deposit-Linked Insurance Fund Central Administration account, at New Delhi on the 1st of each month. The entire balance is transferred via telegraphic transfer to account number 24 on the first day of each month. Since EDLI administrative expenses are initially met from the EPF administration account number 2 at regional or sub-regional offices, withdrawals from this account are generally unnecessary. No other transfers are allowed from this account, except for the rectification of erroneous deposits. Similar to account number for the EPF Central Administration account, this account is funded by transfers from the EDLI Regional Administration accounts, maintained at regional and sub-regional offices through the State Bank of India. Withdrawals from this account are made either through checks or transfer advice notes issued by the authorized officer. On the authorized officer's advice or via check, any surplus amount is transferred to the special deposit account in the name of the Central Board of Trustees, EPF. This EDLI investment account is maintained at the Reserve Bank of India, New Delhi. Similar to the EPF investment account number 5, this account is funded by transfers from EDLI fund contribution account number 21 maintained by regional and sub-regional offices. These funds are transferred through telegraphic transfer to the State Bank of India. Since 1 July 1997, this account has been held at the SBI main branch in Bombay to facilitate the investment of insurance fund monies in accordance with the EPF investment pattern. Previously, until 30th June 1997, this account was maintained at SBI, New Delhi, where investments were made in the public account of the central government. Payments from this account are made by transferring funds back to EDLI fund contribution account number 21 based on the specific advice of an authorized officer. Any balance in this account is transferred daily to the Security Services branch of SBI, Bombay, for investment purposes. Key responsibilities related to receipts include ensuring the timely receipt of challans and bank statements, monitoring for any missing credits or non-receipt of challans, preparing subsidiary cash books and promptly submitting the receipt schedules to the accounts section and penal damages cell, reconciling receipts across various accounts and maintaining accurate cash books, adjusting erroneous receipts and managing transfers between accounts, maintaining proper records of challans, bank statements, and related documents, ensuring the realization of interest on all accounts, including interest on delayed transfers and credits from base branches to link branches, liaising regularly with the SBI link branch. Handling payments involves maintaining detailed records, including the cash book for both cash and bank transactions, checkbooks, money order forms, and a register for valuable documents. After verifying details from the receipt side, all required returns are prepared and submitted. This includes reconciling the scroll inward register and managing check and money order issuances under the 3 schemes. Periodic transfers to other accounts and for investments must be made on due dates. The paid duplicate scroll is forwarded to the accounts section, and monthly reconciliations of all cash books are prepared, alongside a classified summary of receipts and payments for all accounts. Managing payments also includes the preparation of the balance sheet and the income and expenditure statement. Any undelivered money orders or checks are received and promptly reported to the accounts branch, with recredit intimation closely monitored. Additionally, the disbursement of pay and allowances is handled, along with the maintenance of relevant registers. The tracking of money order acknowledgement receipts and related correspondence is also an essential part of the process. The following cash books must be maintained: the cash book for cash transactions, and subsidiary cash books for accounts 1, 2, 10, 21, and 22. Additionally, there is a cash book for bank transactions linked to these accounts. It's important to note that erasures or overwriting in any cash book are strictly prohibited. Mistakes should be corrected by drawing a line through the incorrect entry and writing the correct one in red ink, with the officer attesting it with their dated initials. All amounts must be written both in figures and words, and verified by the drawing officer against the cash book before signing. When not in use, the cash books should be securely stored in steel cabinets, under lock and key. These books should only leave the cash section for audit purposes with proper acknowledgement. The cash section is responsible for maintaining daily, accurate entries, ensuring the physical safety of the books, and having all transactions attested by the Assistant Provident Fund Commissioner for verification. In the cash section, 2 types of cash books are maintained: the cash book for cash transactions and the cash book for bank transactions. The cash book, cash, records the receipt of all checks from employers, cash from staff, and others, and their deposits into the State Bank of India. It also tracks self-checks drawn by the authorized officer, disbursements, and any checks or cash on hand. This cash book covers receipts and payments for accounts 1, 2, 10, 21, and 22, and is updated daily. Self-check transactions for salaries, travel allowances, and other expenses are also noted, with a remarks column used to indicate the date of credit. For accounts 2 and 22, a separate compilation sheet is maintained to classify expenditures by budget heads, with a detailed breakdown prepared at the end of each month. Additionally, a valuable document register is maintained to track the receipt and disposal of checks and demand drafts. A separate cash book, bank, is maintained for each account. This cash book is used to record all credits and deposits into the respective Employees Provident Fund accounts, as reported by the State Bank of India through credit and debit advices, as well as receipted challans. If a check from an employer for their dues is dishonored, an entry marked "Check dishonored" in red ink must be made in the remarks column on the payment side of the cash book, next to the relevant entry. At the same time, a stamp reading "Check dishonored" should be affixed on the office copy of the receipt issued to the remitter, signed by both the cashier and the authorized officer. Checks and demand drafts, DDs, received from employers are accepted, with the date of dispatch to the Regional Provident Fund Commissioner or officer in charge noted as the date of payment. However, outstation checks are not accepted, as per paragraph 38 of the scheme. When collecting arrear dues from defaulting establishments through enforcement or recovery officers, authorities are advised to request demand drafts payable at the location of the relevant regional or sub-regional office. The valuable documents register must be kept securely under lock and key. All checks and DDs should be sent to the State Bank of India the same day or the following day, and no check should be held for more than 2 days. If checks arrive without details regarding the amount payable across various accounts, the accounts section must be consulted before depositing the check into the relevant account. The cash book, cash, should display the status of pending checks daily, and the cashier is responsible for their safe custody until deposit. The cash section is responsible for maintaining a scroll inward register. This register tracks the number of authorized claims received for settlement, including claims under the Employees Provident Fund, Pension Fund, Insurance Fund, transfers, and advances, listed separately. The payment scroll, both original and duplicate, along with the authorized claims, is received by the officer in charge of the cash section. After initialing the original, it is forwarded to the Assistant Accounts Officer or Section Supervisor. The original scroll is retained by the Section Supervisor, while the duplicate, along with the authorized claims, is passed to the clerk for verification. The clerk checks that the claims are in order, ensuring that the amount and number of claims are accurately reflected in the scroll. These details are then recorded in the scroll inward register, which is closed daily. The total number of claims and the amount, broken down by account and payment method, must be confirmed by the clerk with their initials. Let us discuss investment in EPFO. The organization is responsible for managing and investing various funds, which include Employees Provident Fund, EPF, money, Pension Fund money, Insurance Fund money, Surplus EPF Administration Fund, Surplus EDLI Administration Fund, Staff Provident Fund contributions, Pension Congratulatory Fund. Each of these funds must be carefully invested in accordance with the regulations to ensure optimal management and growth. The organization's investment pattern is structured into 5 categories, with specific percentage allocations. Government securities and related investments, a minimum of 45% and up to 50% of the funds must be invested here. Debt instruments and related investments, a minimum of 35% and up to 45% is allocated to debt instruments. Short-term debt instruments and related investments, up to 5% can be invested in short-term debt. Equities and related investments, a minimum of 5% and up to 15% can be invested in equities. Asset-backed, trust-structured, and miscellaneous investments, up to 5% is allocated to these investment types. Fresh accretions to the fund will be invested according to the specified investment pattern, ensuring that the amounts remain within the maximum permissible percentages for each category. Fresh accretions include uninvested funds from previous periods, contributions, dividends, interest, commissions, and the maturity of earlier investments. These are adjusted for any obligatory outgoings during the financial year. Each year, EPFO is required to prepare a budget as per Para 58 of the Employees Provident Funds Scheme and Para 21 of the Employees Deposit-Linked Insurance Scheme. There is no separate budget provision under the Employees Pension Scheme, EPS, 1995. The EPS allows for administrative expenditure to be met by diverting up to 16% of the total Employees Provident Fund administrative expenditure from the pension fund. Expenditure is apportioned in a ratio of 83:16:1 for EPF, EPS, and EDLI, respectively. Each year, the Central Provident Fund Commissioner presents a budget to the Central Board before the first fortnight of February. This budget outlines expected receipts from EPF contributions, administrative and inspection charges, penalties, recoveries of arrears, and miscellaneous income. Alongside the new budget proposals, revised estimates for the current year are also presented. Budget proposals, including the revised estimates for the current year and the budget estimates for the upcoming year, must be submitted by the Regional Commissioner to the Central Commissioner by 15th September each year for review and consolidation. Only standard budget heads should be used. A separate budget proposal is required for receipts under the Employees Deposit-Linked Insurance Scheme. On the expenditure side, the budget is divided into three parts: capital expenditure, revenue expenditure, and repayable loans and advances. Estimates must be accurate, based on the actual figures from previous years and any new proposals. The actual income for the first 5 months should be reported, and projections for the remaining period and the next year should be based on this, along with the average growth rate of the last 3 years. Additionally, actual receipts and expenditures for the preceding year and up to 31st August of the current year must be provided. Regional offices are responsible for estimating their administrative expenses for the upcoming financial year. This estimation process factors in the previous year's actual expenses, anticipated changes due to inflation, pay revisions, or shifts in workload, any new initiatives or planned projects. These estimates are compiled into a budget proposal, which includes a detailed breakdown of expenses under various budget heads, and submitted to the Central Office for review and approval. The Central Office evaluates these proposals by considering the overall financial position of the EPFO, the justification for the proposed expenses, and the need for consistency and fairness in resource allocation across regions. Throughout the financial year, both regional and central offices closely monitor income and expenditure against the allocated budget. Monthly reports. Regional offices submit monthly reports to the Central Office, detailing actual expenses for each budget head. These reports help track spending patterns and identify potential overruns or underutilization of funds. Consolidated statement. After the financial year, regional offices provide a consolidated statement that reconciles the figures reported throughout the year, offering a final overview of their financial performance. Central Office Review. The Central Office consolidates all regional expenditure reports and compares them to the total budget sanctioned by the central government, assessing the EPFO's overall financial performance. If total expenditures exceed the sanctioned budget, the reasons are carefully reviewed. The Central Office may then consider requesting a supplementary budget or identifying areas to reduce expenses in the next financial year. Under Section 5-A of the Act and Para 74 of the EPF scheme, the Central Board is responsible for maintaining proper accounts of its income and expenditure. These accounts are audited annually by the Controller and Auditor General of India. As per Para 55 of the Employees Provident Funds Scheme, Para 29 of the Employees Pension Scheme 1995, and Para 19 of the Employees Deposit Linked Insurance Scheme, the balance sheet must be audited by the Controller and Auditor General and presented to the Executive Committee for review. Afterward, it is submitted to the Board for adoption by 10th December, following the close of the financial year. The audited accounts, along with the Controller and Auditor General's report and the Board's comments, must be submitted to the central government by 20th December for presentation to Parliament. A separate balance sheet must be prepared for each scheme, including the respective administrative accounts. For the Employees Provident Fund, an income and expenditure account is required. Meanwhile, for the Employees Pension Fund and the Insurance Fund, a separate receipt and payment account should be prepared. Preparatory work for balance sheet compilation includes closing all cash books by 31st March and reconciling them with bank statements before 10th April each year. Certain financial details must be handled with specific care during the preparation of accounts. Subsidies received from investment accounts should not be recorded as receipts. The assets listed in the balance sheet must align with the assets register. Group insurance subscriptions for Group A officers should not appear under receipts or payments. Expenditure on sports activities should be classified as an advance, not an expense. Demand figures must match the demand register, with a certificate provided for verification. A statement of surplus amounts transferred to the investment account and subsidies received during the year should be attached. To ensure accuracy and compliance in the balance sheet, several key points must be addressed. All audit observations from previous balance sheets should be complied with. The amount under miscellaneous should be backed with full details. Previous accumulation in securities should be indicated based on the purchase price, verified by a memorandum from State Bank of India. Ensure the withdrawal of securities due to exemption is reflected accurately, and interest released to exempted funds is included in the interest suspense account. Suspense unclassified amounts must be supported with full details, along with an attached list of defaulted establishments. The position of sundry creditors and debtors should clearly show both the opening and closing balances. All advances shown must be supported with detailed information. When handling specific financial recoveries and expenditures, the following guidelines must be adhered to. Recovery of rent from staff quarters should be treated as revenue and classified under miscellaneous receipt in the income and expenditure account. For electricity charges recovered from staff salaries for allotted quarters, the amount must be remitted directly to the electricity department. It cannot be treated as a revenue receipt. The entire cost of staff cars, furniture, and office equipment should be recorded as revenue expenditure in the year of purchase and charged to the income and expenditure account. No depreciation is required for these assets. Interest on refundable advances should be displayed separately under the caption, Interest realized on refundable advances on the income side of the income and expenditure account. The Staff Provident Fund, SPF, administered by EPFO serves to provide retirement benefits to its staff and is centrally managed by the Central Office. Investments. The SPF follows a conservative investment strategy, similar to the main EPF scheme, by investing in secure government securities. Subscriptions. Staff contributions are automatically deducted from salaries each month, promoting regular savings towards retirement. Advances and withdrawals. Provisions allow staff to take advances or partial withdrawals for specific needs, such as housing or medical emergencies, ensuring financial support when needed. Final payments. Upon retirement, resignation, or death, the accumulated balance, including interest, is paid out as a lump sum to the staff member or their beneficiaries. Annual statements. To maintain transparency, annual statements are issued detailing contributions, interest earned, and the total balance in each SPF account. Interest rates. Interest is credited to the SPF accounts annually, with rates determined by the fund's performance, similar to the EPF scheme. EPFO offers a pension scheme for its staff, ensuring their financial security post-retirement. Accounting procedures. Rigorous accounting practices are followed to meticulously track contributions, interest accrual, and pension disbursements, ensuring complete transparency and accountability. Pension authorization. A defined process is in place to ensure that pensions are accurately calculated and paid on time to eligible staff members. Payment through SBI. To streamline disbursements, pension payments are made through State Bank of India, SBI. Retired staff must open an account with SBI, similar to the process followed by general EPF pensioners, ensuring consistency in operations. No dues certificate. Before the final pension payment is processed, retiring staff members must obtain a no dues certificate from EPFO, confirming that all outstanding dues and liabilities have been cleared. EPFO provides its staff with life insurance coverage under a group insurance scheme, GIS, ensuring financial protection for their families in case of unforeseen events. Policy purchase. The group insurance policy is purchased from the Life Insurance Corporation, LIC, of India, a trusted, government-owned insurance provider. Nominations. Staff members under the scheme are required to nominate beneficiaries who will receive the insurance payout in the event of the member's death. Contributions. Both the EPFO and the staff members contribute to the premium payments for the GIS, following a shared contribution model similar to other employee benefit schemes. Premium payments. The EPFO collects contributions from staff and remits the consolidated premium to LIC, ensuring timely and accurate payments. Let us discuss audit in EPFO. The internal audit is an independent evaluation conducted within the organization to assess its accounting, financial, and operational activities, supporting overall management. Its primary objectives are: ensuring accuracy in financial accounts, enhancing the efficiency of financial operations, verifying compliance with established procedures for receipts, payments, and accounting. Ultimately, the internal audit serves as a quality control mechanism, ensuring that financial management follows all prescribed regulations. The statutory audit focuses on propriety, system, and performance audits. Its goal is to ensure compliance with general financial and accounting rules and legislative enactments, upholding fiscal accountability and establishing public accountability. Statutory audits review the regularity of financial transactions and highlight discrepancies in draft audit reports for further action. In contrast, the internal audit is primarily concerned with the financial propriety of transactions. It identifies breaches of propriety and reports them separately while also providing constructive suggestions to improve the organization's accounting capabilities. Together, these audits ensure a comprehensive review of the organization's financial health and processes. Duties of internal audit. Effective financial management requires a thorough approach to accounting procedures and auditing processes. Key responsibilities include study of accounting procedures, reviewing the prescribed accounting procedures to ensure they are correct and adequate, identifying any defects or gaps. Monitor implementation, ensuring that procedures are followed and all orders are implemented correctly. Scrutiny of payments and accounts, conducting thorough checks of payments and accounting work by the accounting units to maintain accuracy. Investigation of errors, investigating significant errors found in accounting records and taking corrective action. Periodic review, conducting regular reviews of all accounts and records to ensure ongoing compliance and accuracy. Settlement of audit objections, addressing and resolving audit objections raised in previous statutory audits. Report irregularities, reporting any irregularities or concerns identified to higher authorities for further action. Let's now look at the Fraud Risk Management Committee at the regional level, or RFRMC. Constitution of the committee. The officer in charge serves as the chairperson. The committee also includes RPFC, Administration, or APFC, Administration, and RPFC, Finance and Accounts, or APFC, Provident Accounts Committee. Jurisdiction of the committee. The committee at the regional office level handles fraud cases involving amounts less than 25 lakhs rupees. Upon detection of fraud, they will immediately notify the respective zonal level committee. However, the RFRMC is responsible for conducting the investigation and taking necessary follow-up actions, such as filing an FIR. Once the investigation is complete, the RFRMC submits its report to the ZFRMC, FA and CAO, and Chief Vigilance Officer, CVO, within the stipulated time frame. For cases with national or international implications, a reference will be made to the CBI, following existing procedures. This structure ensures fraud is managed efficiently at the regional level while maintaining coordination with higher authorities when necessary. Next, let's examine the Fraud Risk Management Committee at the zonal office level, or ZFRMC. Constitution of the committee. The ACC, zones, serves as the chairperson. The committee includes RPFCI, who is the zonal officer in charge of finance and audit. Additionally, the officers in charge, OICs, of regional offices within the zone are part of the committee. Jurisdiction and responsibilities. The ZFRMC monitors the progress of investigations carried out by the RFRMC. When fraud cases involve amounts of 25 lakhs rupees or more, the ZFRMC must take up the matter directly. Upon completing the investigation, the ZFRMC submits its report to the FA and CAO and Chief Vigilance Officer, CVO, within the stipulated time. In cases of larger frauds, a reference to the CBI is mandatory, following the standard procedures. Both the regional and zonal fraud risk management committees are responsible for periodically reviewing claim settlements and other operational processes. Their goal is to detect, investigate, and report any instances of suspected fraud within their jurisdiction. Upon detecting fraud, these committees must ensure a prompt and thorough investigation, followed by immediate further action to address the issue. This multi-tiered approach ensures robust oversight and timely action at both the regional and zonal levels. This committee plays a crucial role in managing and resolving overpayment cases efficiently. The committee is chaired by the zonal ACC, with RPFC, zone, as a key member. Their responsibilities are clear and focused. Address overpayment issues promptly by identifying responsible officers and determining the recoverable amounts. Review overpayment cases flagged by statutory and internal audits, ensuring swift and appropriate action is taken. Revisit unresolved cases, ensuring that accountability is assigned without delay. Document proceedings and enforce recovery actions in a timely manner. Conduct at least 2 reviews annually, in January and July, with additional meetings if needed. Ensure recoveries are completed by the end of the financial year. Regularly review the causes of overpayments and share preventive strategies with staff to avoid recurrence. This committee's diligent oversight ensures that overpayment issues are handled swiftly, responsibly, and with a focus on continuous improvement. Thank you for watching. Keep learning.